In the US, a person in their mid-20s typically has roughly $10,000 saved for retirement. What kind of cash dividend yield could a portfolio of this size be expected to produce? You might be surprised at how much it will yield in dividends on its own, even though $10,000 won't be enough to fund a standard retirement. It can be sufficient to cover your expenses or fund a trip. Examine the numerous circumstances that could lead to different income levels. This can help you estimate how much cash you will require to achieve financial independence. Hello there. We appreciate you visiting Stock Market Mate, where we show you the latest news, ideas, and research here on investing within the stock market. The procedure of generating a $10,000 dividend income will be covered in today's video. If you haven't done so already, subscribe and press the bell icon to get a notification anytime we release a new video. Continue watching if you want to find out about a critical mistake that some investors make, as well as how to maximize your investments so that you can earn significantly more money in the future. The S&P 500. Different levels of dividend income are offered by numerous investment alternatives. The most well-liked investment is probably the S&P 500 index. The reason why this is so well-liked is that it allows investors access to 500 big US firms with a history of financial stability and success. You hold a position of each area and industry that makes up the stock market as a whole because it is well-balanced. The S&P 500 has a proven track record of generating positive returns, which is why Warren Buffett suggests it. When most investors refer to the market, they mean something like this. A dividend yield of less than 1.5% is what you'll earn if you invest in an EFT or index fund that follows the S&P 500. This is due to the fact that a large portion of the largest shareholdings are technological firms with a reputation for paying minimal or no dividends. With a $10,000 investment, this index would only provide roughly $150 per year, or $12.50 per month in dividends. The Dow Jones Industrial Average, or Dow. Another well-liked investment is the Dow Jones Industrial Average, usually abbreviated as Dow. Another index that investors frequently refer to as the market as this one. The Dow, which regularly comes in second place to the S&P 500 and is made up of 30 of the biggest US firms, is viewed as a secondary indication of the state of the US economy. The dividend paid to investors who purchase the Dow fund is somewhat greater than the S&P 500 at just over 1.5%. Investing in a fund that prioritizes income rather than capital growth could result in a higher dividend yield. Investments in solid company stocks with a lengthy history of dividend payments are available in a wide range of high-quality possibilities. Investco S&P 500 ETF. One example is the Investco S&P 500 High Dividend Low Volatility ETF. Instead of holding every company in the S&P 500, which would only own those that pay the greatest dividends, this produces a dividend yield of about 4%, which is significantly higher than the average S&P 500. Long-term growth has slowed dramatically as a result. The yearly dividend income on a $10,000 investment in this fund would amount to about $400 or $33 per month. For elderly investors, there are several additional high dividend funds available. They're well liked by seniors because they offer more stability. In bull markets, they underperform, and in bear markets, they perform better. It's not surprising that these are widespread among retired folks when you consider their constancy and regular income. Investing in a sector or industry-specific fund is an additional opportunity for investors to receive dividends that are higher than normal. Such a fund solely makes investments in a single sector or industry, such as the production of electricity, real estate, or healthcare. Some industries offer greater dividends than others due to the nature of their business and the fact that many investors are cautious of the fluctuations brought on by the economy's instability, renewable alternatives, and regulations. The energy industry offers a strong dividend yield and is valued relatively low. For instance, the maximum dividend yield for the Vanguard Energy ETF is 3%. Additionally regarded as rather hazardous, real estate investment trusts send the majority of their income to shareholders in the form of dividends due to the nature of their corporate structure. The yield on the Vanguard Real Estate ETF is likewise above 3%. Investors that are prepared to do their homework and buy into markets that are out of favor stand to benefit financially. The benefits will come in the shape of dividends and capital growth when the sectors start to rotate back into favor. An investment of $10,000 in the real estate or energy ETF from Vanguard would generate around $300 in annual income or $25 per month. Additionally, acquiring individual stocks is only another choice. Nevertheless, if you're a newbie with a small portfolio, many financial experts advise buying index funds or ETFs. Without taking on too much risk, you may learn about market behavior, generate reliable returns, and grow your portfolio. If you're willing to do the homework and take a chance, you might choose individual stocks in the end. When purchasing individual equities, you should consider past performance and dividend growth. The Dividend Aristocrat List. Because each member of the Dividend Aristocrat List has a history of increasing its dividend for 25 years running, it is a solid place to start. ABBVie, an aristocrat dividend stock, offers an approximately 4.5 dividend. You would receive about $450 in dividends each year, or $37 per month if you invested $10,000 in this business. Additionally, you will get any capital gains or losses based on the future price of the stock. In addition, it's a good idea to consider the fundamentals of those prospects and look for reasonable payout ratios of 50 to 60% or less positive profits, among other potential indicators. Due to their tendency to sell off, individual stocks regularly present possibilities for savings, whether as a result of recent negative news, missing results, or management changes. This might be a chance because the stock market frequently overreacts. Since the majority of investors with $10,000 or less are still several years away from retirement, a prudent investor must weigh the seriousness of the news and make an informed decision regarding the stock price. They should start thinking about completely ignoring dividends. Why? Because long-term returns on investments in growth stocks tend to be substantially higher than those on assets that pay dividends have historically been lower. Young people must often experience development throughout their careers. A 2% variation in the rate of return on an annual basis can have a big impact. For instance, a person who invests $10,000 at the age of 25 and receives an 8% return until the age of 65 will have $217,500. By the time they were 65, they would have more than doubled their money if they have received a 10% return, or $450,000. It's important to keep in mind that growth stocks might be more volatile, which can be difficult for investors who are not accustomed to market changes to manage. Vanguard's ETF. For younger investors, an ETF like Vanguard's Growth ETF, or VUG, is a fantastic choice. It invests in large-cap growth equities like Apple, Amazon, Home Depot, and other well-known companies, as the name suggests. A growth index is likely to outperform the S&P 500 over the long term, which is great for someone who has a long time before they need income. Due to the fact that the majority of its holdings pay little to no dividends, VUG's dividend yield is less than 0.5%. To ensure that the business keeps expanding quickly, they instead reinvest revenues back into it. Due to the low dividend yield, an investment of $10,000 would only return less than $50 in dividends annually, or around $4 per month. This fund has traditionally been in the market, but there are many other excellent choices. People are frequently preoccupied with dividend yield and choose investments that are appropriate for their time horizons. In general, an investor with a $10,000 portfolio would perform better to focus solely on growth and completely disregard dividends. How big of a difference in your life does money make? Whether it's $50 a year or $400 a year, it probably won't make a big difference when it comes to covering your everyday costs and paying your bills. Growth stocks would therefore give you additional money when you're almost ready to retire. At that point, if it makes sense, you could change your growth investments into income investments. Avoid the rookie error of concentrating primarily on dividend yield. We appreciate your time. We are hoping that these suggestions may be useful. Please subscribe and enable the notification bell if you enjoyed this video so that you may be notified when we upload more content similar to this. And we'll see you again soon. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!